All right, thank you for taking a look at Iron Ranch Business Park. This is our financial analysis. We also refer to it as our investment presentation, but we had a deck, a whole presentation on PowerPoint. If you haven't watched that, take a look at that one as well. But here we go through the numbers. I like everybody to understand what we're doing, how we're doing it, what it looks like, etc. So let's talk about that. Iron Ranch Business Park in Fate, Texas. Here's the numbers. Total, we're going to be all in at $27 million. Okay. 3.9 for the land. Our construction costs, hard and soft costs, $18 million. Now, we think we're going to be way under that, so I wanted to be conservative. The average of all of our bids was 17 million before doing any final construction numbers, final construction bids, or what they call value engineering, which is ways that you modify it to go ahead and save money. And so we think we're going to go ahead and save some money on that $18 million. We budgeted $1.6 million in tenant improvements. Now, this $18 million gives a white box to everything that they can move into, but another basically $10 a square foot for finish out. If they want to add some walls or add another bath, whatever it is, to go ahead and make it work for those tenants. We budget in leasing fees to go ahead and pay to leasing agents, and that's outside agents as well as our in-house leasing agent, Alan Ackerman, and he will be doing that. Just to give you an idea, if we did if we called a normal leasing broker, leasing commissions to lease this up would be over $600,000. So we're doing it at a big discount. We still have to pay some outside people, but that's included in there. Closing costs, $800,000. Our loan origination is $400,000. We're putting $1,450,000 in interest reserves, and that's to pay the mortgage payment for the first year. It's actually much lower than that. We can see down here on our interest-only schedule, it's $1,260,000. So we wanted to make sure we had plenty of cushion in there, or just in case in this crazy financing market, whether or not we could get interest only. But I think we can, but I wanted to be conservative to make sure we have it in there. If not, we've got another $200,000 in reserves. Holding costs, $200,000. And then also that holding cost, that's for our expenses in year one, which is really property taxes, insurance, some utilities, just things that we have while we own it during construction. Operating reserves, $500,000, just so we have $500,000 in the bank, which is overkill. But again, I'd rather be very conservative. Total cost, $27 million. Loan proceeds, we're looking at an $18 million loan, so we need $9.1 million to go ahead and close on this. Again, if you saw the other one, the internal rate of return, 21.8% average annual return, internal rate of return over the term. Now it's over 5 years. However, by year 3, when we do the refinance, you'll get 116 projected at 116.8% return when we refinance. Now you also have cash flow that was another $25,000 or so. So you're going to be at $140,000 cash out and still have ownership. And that would pretty much all be tax-free because of that refinance. Now, our loan, $18 million. I've got it at 7% right now. Want to be conservative. We can probably get that at a lower rate, but let's just say we can get it at 5.5. It moved just that little bit, moves the return to 22.2. Okay, so I like watching and see what little changes do. 5-year loan, it's a construction loan, so we'll be out of it sooner, basically in 3 years, and interest-only payments. Now, in year 3, the end of year 3, we're looking at being able to get a $30 million loan. That pays off all of our construction costs, all of our reserves, everything, and gives 116% back to our partners. So that's an exciting part. Everybody loves that. Here's our current rent schedule. Pre-leased, we have 42 leased at $2,750 per unit. That's $20 per square foot, okay? Those are the pre-leased unit. Now, we do not have signed leases on that yet. However, We have those all in line, and once we close on the property, we'll start signing those leases and those letters of intent. The pre-leased and the standard are the same, so we got 62 units of those. We've got the collector spaces, and we've got premium spaces. The premium are basically the front spots. Okay. Our performer rent schedule, and that's what it was when we started looking at this about 6 months ago. So we're budgeting when we finally get this done. We've already got them pre-leased at $2,750, so I'm going to leave those there. Also, the other ones at $2,750, the collectors at $2,888, and the premium at just over $3,000 per month. Now it's $22, $21, and $20 per square foot. It's funny, you can actually find less expensive office flex space in highly developed areas. For example, take Southlake, Texas. You'd think that would have a lot higher rent. There's so much competition, so much space that the rent is cheaper. That's why our business model is focusing on areas that are underserved by office space so that they can go in here. So that's where we are. Now, here is our pro forma. We're doing stabilized year 2 because year 1 will be construction and leasing, and then we'll be up and running. Budgeted in 10% vacancy and collection loss. Rental income, $2.9 million. Now, here's one of the biggest benefits of having a product like this, like office, office flex, etc. Every lease is what's called triple net, 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 net. That means that the tenant gets billed back for all of the operating expenses. So, give you an idea, our operating expenses down here are $1,058,000. Okay, you see that? Well, if you take a 10% vacancy off of that, because we have to gross it up, because if we're 50% occupied, you don't want half of the people paying the whole bill. They wouldn't like that. That doesn't work well. So, but they do pay their pro rata share of all this. Let's just say that something happens in here and we have an extra $300,000 expense. Okay. That triple net goes way up because it's billed back to those tenants. Now we got to be fair and run that very well. We have triple net leases, for example, at our office building in Irving. And when we took over the property, because we were managing so effectively, we actually lowered the overall expenses pretty dramatically and gave money back to the tenants. Because what they do is they pay their rent, plus we budget how much they're going to have to pay to collect to catch up to the end of the year. So we're collecting that each month. And then at the end of the year, we do a reconciliation. It's kind of like you do with your income taxes. It gets taken out of your check. At the end of the year, you might have to pay some, you might get a refund. Expenses, management at 6%. We've got contract services, which is, trash, groundskeeping, things like that, simple. Low maintenance, low utilities, our insurance, property taxes, and of course, contingency. Always plug in contingency so we're safe. Now, if I really do bad, 15% vacancy, or really do good, 8% vacancy. Really do bad, I'm estimating expenses at 1.153, so $100,000 higher than this, and $100,000 lower if we can be aggressive and really save money on our expenses. We do have company expenses. Those are asset management fees, tax returns, accounting, etc. That's not stuff we can bill back to the tenants. Plus we throw $20,000 a year in reserves. That's just in case. And our debt service gives us our cash flow of $1,498,000. However, that does not include if we were to get private equity or our pref payment, anything like that, that'll be on the next page. To give you an idea on how well this looks, 2.28 debt coverage ratio, cap rate 10%, cash on cash return 16%. Okay, that would be very, very good. And that's just at the property level. So now we go out 5 years. And what does 5 years look like? Okay, year 1, budgeted revenue, but no actual revenue because we're building. Okay, then we're going to have expenses maintenance, utilities, insurance, taxes which are based on just the land value right now, so the first year will be cheap, plus 20,000 in contingency. So we've got a loss of $128,000 year one. Now again, remember, I budgeted $200,000 for that expense, so we got plenty of cushion there. Then we're gonna have debt service that would take it down into negative further. Again, I budgeted $1,450,000 in there for our debt service if it's amortizing, but $1,260,000 is the amount that we budgeted in here for first year. Also, we're not going to use all of that in the first year because we're doing construction. So that's actually going to be a lot lower number, but still wanted to go ahead and put it in there. Now we're growing at 3.5% rent per year and 2% on expenses. Now the beautiful part is the expenses being triple net leases. Anything, if it goes up, just like I just mentioned, any expenses go up, we're still covered. So our returns are absolutely protected because the tenants have to pay the expenses. So it doesn't really matter if that changes. It doesn't affect things very much at all. Year two, we're looking at net operating income of $2,970,000 and cash flow of $1.6 million in year two. That is absolutely huge, absolutely huge. Year three, same scenario. We've still got the 8% vacancy loss, 2% collection loss, our rental income, plus our other income, the CAM charges we build back. And then, so total operating income, $4.1 million. We have expenses, management, contract services, maintenance, utilities, insurance, property taxes. And of course, always budget in a contingency, $81,000. Our net operating income is $3 million. Here's where things get interesting, okay? You know your value is based off of a cap rate. We budgeted a 7% cap rate in year three. That is extremely high, even for right now. Our current cap rates on apartments are still in the 4s up to 5, maybe even 5.25 on apartments. I'm budgeting 7 for a value at cap rate. That means it's going to be worth $44 million. We're looking at doing a 70% cash out refi for $30 million. Pay off the loan, pay our closing costs, we'll have $12 million in proceeds. Now we only raised $9.1 million, so that gives us plenty of money to pay off all of the investors. This is a different look on this 5-year pro forma than you've seen in the past because it has a waterfall in here. Okay, the way we handle this, again, these numbers here directly off of the bottom here, for example, $971,000 in cash flow, $971. The value in year 5, we're saying is $47 million, and proceeds of $16,207,000, and that carries right back over here, $16,207,000. So the first year, 10% pref. Well, we don't have any income, so we're accruing that preferred return. So we are accruing that preferred return. So really the investor's balance is now $10,010,000. That's the $9.1 million plus the $910 that accrued. So now the next year, so there's no more income or expense that first year. Next year we have $1.6 million in income. The preferred return at 10%, that's 10% of your balance of your capital account. We have to pay out $1,001,001. We pay that out. Investor balance stays the same because we actually paid out the pref. Then we'll have $600,000 in cash flow to split. We're doing a 75-25 split with the investors keeping 25%. And that's because we're giving a 10% preferred return right up front. So investors get 149,000, sponsors get 449. So we don't make anything beforehand on any of this cash flow until you're getting back $1,150,000 before we make anything. Okay. Year 3, still have 1.7 in cash flow. Sales proceeds $12 million, so $14 million coming into the property. Pay the preferred return. Okay, investor balance stays the same. Splitting the cash flow, 25% to the investors. So the investors are going to get $1,179,000. That's the $1 million in pref plus the split. And they'll get their original cash back of $10 million. Okay. And then the proceeds to split, the investors will get another $600,000 on top of that. So total to the investors, $11,790,000. Okay. Year 2, there's no pref to pay because we paid everything off, and we've got cash flow that's still splitting, so investors still get $212,000. When we sell it, same scenario. If we sell it after year 5, that'll be additional to the investors. Now, that is a lot of information, so I try and simplify it and just say, what's in it for me? And that's what I do this area for. If somebody invests $100,000 as an example, they can expect 0 in year 1, 12,000 in year 2, so a 12.6% return year 2. Year 3, $129,000 in cash back. Now that most of that comes from a refinance, which is tax-free. So now you have $129,000 into year 3 to go invest into another deal. Then you get $2,300 in cash flow. That'll go up slightly every year as long as we own it. But if we were to sell it at the end of year 5, you also get sales proceeds of another $50,000 back. It's a total IRR of 21.76%, 21.8% if you're rounding off. So that is an absolute spectacular return. And for a very well-known product in a great location, and the returns for the partners, again, are outstanding. And again, even if we don't hit, you see I have a lot of cushion in there, but even if we don't hit that, the investor's preferred return is still 10%. So that's all great information. We do have, because this is a new development, we've got another entity, Iron Ranch Development, and we will be the developers and the sponsors. And in that, there are some developer fees, there's acquisition fees, there's leasing fees, there's fees in there that would be earned by anybody that was doing that anyway. And it's discounted off of what it would be for somebody else as well. So bottom line is you make a ton of money, 21.8% average annual return with getting 116% on the cash out refi, which is really 129,000, you've already got 12, so you'll be over $140,000 back in 3 years. So that is an outstanding return. And we love this development. We're getting started on it. We're closing on the land in December. We are going to start off by raising $5 million of that 9.1 to go ahead and close on the land and to go ahead and finish up the drawings and architectural drawings and all the associated fees that we need to go ahead and get moving on that. That also gives us construction plans to have hard bids, and those construction plans and hard bids, we'll go through those for value engineering to see if we can save some more money off that $18 million. Plenty of cushion, great returns. What if the cap rate when we sell it is not 7%? What if that went back down to a level that we've been at for a long time? Let's just say that's a 5%. Okay, look at the per year, your IRR at 21%. We just take this, actually it's not even be that aggressive. Let's take that to a 6% cap rate. Okay, 6% cap rate. Watch your 21.76. It's now up to 24. Cap rates go back to 5, 27. So the returns are great. There's a lot of cushion in here. We are looking forward to doing this deal, and this won't be the only one. This will just be the first one, and we hope to have a few more sites at the beginning of next year, and love to have you involved in those as well. So thank you so much. Reach out to our team, and they can get you hooked up and get you involved in this outstanding investment. Thank you so much.